Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
G'day and welcome to the Global View on this Monday. I'm Andrew Gagan. Good to have you with us again as we get this week underway here at Ausbiz. Let's take a look first what happened on Friday. Mixed session with European shares slightly lower but ending the week higher. On Wall Street, the Nasdaq notched yet another record close. And for the week, the Nasdaq added 2%, the S&P rose 1.6% and the Dow up almost 1%. The mega-cap tech stocks drove the Nasdaq higher on Friday. Microsoft gaining after the tech giant avoided a possible hefty EU antitrust fine by offering customers reduced prices for office products excluding Teams. Tesla shares surged after board chair Robin Denham dismissed concerns that chief executive Elon Musk's political activity had hurt sales at the EV maker and said the billionaire was front and centre at the company. Declines for Goldman Sachs and paint maker Sherwin-Williams dragged on the Dow. Warner Brothers Discovery shares extended a surge from early in the week when a source said Paramount Skydance was preparing a bid for the struggling media company. And shares of vaccine makers fell on reports that US health officials are planning to link coronavirus vaccines to the deaths of 25 children. Well, US consumer sentiment fell for a second straight month in September as consumers saw rising risks to business conditions, the labour market and inflation. The survey's measure of consumer expectations for inflation over the next year was unchanged at 4.8%. US Treasury Secretary Scott Bessent plans to meet with Chinese Vice Premier and other senior officials next week in Madrid, or this week I should say, in Madrid to continue their discussions on trade, economic and national security issues. The meetings will also cover the status of Chinese-owned social media platform TikTok. Well, US Treasury yields rose in subdued trade on Friday as investors digested that weak economic data that does potentially open the way for the first monetary policy easing in 9 months when the Fed meets this week. The yield on the US 10-year note initially ticking lower after the sentiment survey before finishing at 4.06%, the 2-year rising to 3.56%, while the Aussie 3-year government bond yield rose to 3.47% with markets pricing in just a 10% chance. The RBA cash rate will be cut by 25 basis points at the next meeting at the end of this month. US dollar index was little changed. The Aussie is trading at 66.5 US cents and Bitcoin is trading at around 115,000 US dollars. Oil prices rose on Friday after a Ukrainian drone attack suspended loadings from the largest port in western Russia. Gains were capped by concerns about US demand. Brent crude futures at $67 a barrel. Copper little change, while iron ore rose marginally to 105 US dollars a tonne. And gold up 0.25% to around $3,640 an ounce. Let's get more on what we're seeing on global markets in the moment. Chad Padowitz joining us from Tewari Capital. Chad, welcome back. Good to catch up with you again. Now, of course, so much focus on AI continuing. We saw that last week, particularly that result with Oracle. It was really more about, though, what's to come, the outlook for Oracle. Yet, economically, we are seeing some weakness emerge in the US, particularly on the jobs front. Can those two be linked? The spending on AI, perhaps the job replacement? What are you seeing?
Yeah, well, I don't think it's probably too early to see a significant job replacement showing up out of AI. I know that's obviously a medium-term risk, and we shall see how that goes out. But if you actually just look at historical economic data, 2 years after a peak of interest rates, where we are actually right now, tends to coincide with peak unemployment. So the weakest jobs number are actually historically consistent with the interest rate cycle. And you tend to require a sustained decline in interest rates for some time before that changes. So I don't think AI is showing up as anything different in the economic cycle at the moment.
So what's the expectation as to when you're likely to see unemployment fall again in the States once this interest rate cutting cycle resumes?
Yeah, so usually there's an 18 months to 2 year time frame between dropping interest rates until the economy actually recovers sustainably, where the employment market actually moves sufficiently positive. So I think there's some ways to go. Now, obviously, every cycle is different, and you do have AI, and you've also got tariffs and other things going on at the moment as well. So it's a very complicated setup we have now. But if one just looks at the economic data, that would imply that we've still got some ways to go, well over a year before unemployment actually starts improving.
Are we likely, do you think, to see ongoing impact from tariffs? Have they yet flowed through? Because certainly evidence perhaps that companies have still been reluctant to pass them on to consumers. Do you feel as though that perhaps is now about to change?
Well, I think you have the challenge, as we've discussed, that the jobs market's not very strong, and you also have consumer sentiment, which you mentioned, is also not very strong. So the ability of companies to pass through prices is limited. So I think more and more companies, if they're able to, will wear some of the tariff cost, which will have an impact on margins and profitability and earnings. I don't think that's happened yet. I think that's going to play out over the next year. So I think that's a key risk for the equity market over the next year.
Now, perhaps more broadly, what's weighing on investor sentiment at the moment also is the level of government debt we're seeing across the globe, and that has been reflected also what we've seen on the bond market, in particular countries such as France and the UK, but also clearly an issue for the US and Japan.
Yeah, so the debt problem is a significant one. I mean, it's well known with, Doge in the US with Musk, who eventually kind of gave up on that. But France is the most obvious at the moment. They have about 3.4 trillion of debt. And they try to put through some budget measures, one of which was, I think, reducing certain things by about 40 billion, which is not a very big number in the context of their debt. And that was enough for effectively for the Prime Minister to be kicked out. So there is a very big challenge to reduce spending on things that people, once they've received, don't want to give up. France is in the firing line, as I mentioned, because they don't control their own currency. They're not as big economy. They're not as dynamic an economy as sort of the US. But it is a global problem that I don't see any obvious way of it being solved in a way that won't be somewhat painful for various investors along the way.
What's the likely effect then, particularly when you take a look at fixed income? What's your view, Chad?
Yeah, look, we're on the global equity side. So, but generally fixed income, if on the credit side, if people think that the borrower is less likely to pay, well, then you're going to have an increase in interest rates. Or if they think inflation's going to be higher than normal, because one of the ways you deal with high debt is inflate the debt away, which obviously if you have long duration bonds, they're going to be worth a lot less. So I think that is a risk within the fixed income market, depending where you are in which countries and the duration. But it certainly will be an area of focus as we deal with these issues.
Now let's take a look at a company that you're focused on at the moment. It just so happens to be a French company. Interestingly also, Chad, I note it's in the energy sector, which has of course been under pressure. That stock being Total. Why are you looking at this one?
Yeah, look, we are a value manager. We do look for companies that often tend to be out of favor, trading at attractive valuations, but still being very important and highly profitable and successful companies. And Total, it's a very large company, about 100,000 employees, operates in about 120 countries, predominantly oil and natural gas. Why we like them? Well, they have a very well covered dividend, which is over 6%. They're buying back shares at around 2% of their shares in issue a year. They have very manageable debt levels. So you're getting the PE is around 7 times. So it's very attractively priced. You're getting a very high return back. And that's at current oil prices. And then on sustainability and ESG, they're actually one of the leaders in that. They're looking at about a 40% reduction in emissions between 2015 and 2030, and having around 30% of production coming from renewable sources. So on various different ways of looking at it, it's attractively valued. It gives most of that earnings back, and they're on the right side of the decarbonisation trend within energy.
Chad, more broadly, are you liking European equities at the moment?
Well, we think US equities specifically are particularly expensive. So we are seeing more opportunities outside of the US, and obviously the European market is home to many of those. We're not taking a specific view or call on any individual European countries. Rather specifically, it's bottom up where we see opportunities, and many of those tend to be in Europe. We have around 40% of our portfolio in the US and about 30 odd in Europe. So it's a fair amount, but not the most.
Chad, always great to get the outlook from Tewari Capital. Thanks very much for joining us.
You're welcome. Thank you.
All right, let's turn our attention then to the local market. Just ahead of the start on this Monday, looking for a negative start, off around 2/3% in terms of the SPI futures there. That's a bit of a weak lead in, also what we saw on Friday with global equities. Stay with us. We'll get right across that in just a couple of minutes.